Hello everyone, this is Jerry Broussard with CajunMoney.com with this month's edition of The Big Picture. And we'll get right to the charts. On this month would be the month of September. Today is October 1st. I'm going to be posting this, but this is for the month of September. It was a very volatile month, and as you can see on the chart, pretty much everything was down for the month. It was a pause, it's to say the least, and in some areas a pretty good dip. I've talked to quite a few people over the last couple of weeks, and the biggest question I always get is this the big drop that everyone's kind of talking about? And we'll kind of get to that in a couple more charts in just a second. But to start with, let's take a look at how the markets did for the month of September. And as you can see, the S&P 500, which is red, was down 1.38. The Dow Jones large company stocks was down about 0.25%. The technology stocks about 0.75%, and the big loser was the international market, which was down almost 5%. And there's a lot of things going on internationally that making the market very, very nervous. And so it took a big pullback in the month. That's just for 1 month, at almost 5%, 4.88. A middle of the road portfolio. This is our proxy that I'll show each month that shows what a balanced portfolio of roughly half stocks, half bonds, what it would look like, and that would have been down about 2% for the month. And the last one at the end is the bond market. It finally paused, and it took a negative of 0.6, just above 0.5%. So as you can see, pretty much everything was down. But one of the things I want to look at real quick is the middle of the road portfolio down about 2%. And so this is kind of an example of if you have a little bit of bond and you have some stocks, let's say half and half, and some of it's in international, that's really what causes some of this drop in the middle, is because part of that came down because of the international market. So it is taking a pause. The international is a pretty good place to be sometimes, especially when it's in a growth mode. Right now it was relaxing, as you can see, and I believe, not relaxing, but it did pull back. And but I do want to show the next chart how the big picture is, which is what we call this video. This is just for the month as I'm describing. The next chart is the same set of investments except for the year to date. So far through the year, as I just showed you, the markets are down pretty strong, or down fair. And this chart shows that we're still in the black across most of the board, again except for the international. The stock market, the S&P 500, up about 8, a little bit above 8.5, or less than 8.5. Dow Jones about 4.5. Technology up about 13, and international's down now because of that big drop last month or this month. And then the middle of the road portfolio is up just under 3%. For the first 9 months of the year, and bonds are up about 4%. So again, this is a good proxy of a middle of the road portfolio. When you got a little bit of this and some of this and some of the international, you end up with what I consider a balanced portfolio, and something that would be up year to date about 3%. And I put this section in here primarily because I do often get the question from readers and from my video followers and whatnot. And one of the biggest questions when they do see this, I kind of addressed it last month, when they see these big up runs and they have a balanced portfolio and they up about 3%, and they hear the stock market's up 8%, the internet's up 13%, and sometimes that's the part that most people will pay attention to the most, because we all like large jumps. And their portfolio might be not up quite as much. And it's because of the balance of it. And so when you own a little bit of each of them, you have a steadier ride, but you don't quite get the big jumps. Because what happens when you get these big jumps, they also can go negative 13 that same month. And so that volatility is something a lot of people don't want to deal with. So a good balanced portfolio is still up year to date, but it's something we'll have to watch and see if those things will change over the next coming months or coming weeks. I'm watching it very closely. We did have a big down day in the market today, and we'll look at a little bit more detail in just a couple of charts here. This chart is the S&P 500, and it's a point and figure chart. We've talked about that many times on my video. My point and figure charts kind of take out the noise and eliminate a lot of what you see on TV and whatnot. And when you look at this chart goes back all the way to 2011, and you can see the blue lines moving up to the right from the bottom left. That's very nice chart when you see it moving up. And if you look up here into the right corner, it's kind of it's a drop in the market right here where I'm showing the cursor, but it is not as severe. I mean, don't get me wrong, any drop is painful in a portfolio, but if you look at it from this standpoint, you can see that it's not as, if you turn on the TV, you swear we're all the way down here, and it's pretty much similar to some of the pullbacks we've had over the last year, roughly. So we're going through that. I believe, as you can see where this line's at right here, we have quite a bit of consolidation right here. We will probably have some support in that area, or we could go all the way to the blue line. Many a times I've said in the video and in my blog that we haven't tested this blue line in quite a while, and it might be time for that to happen. We'll have to wait and see, but it's not a end of the world type of market action we're going through. It's what I would consider normal market action, as you could see pretty much on this chart. This next chart is a different chart. Let me jump back real quick. I'm sorry I jumped over that. This is a daily look at the S&P 500 with a point and figure. This next chart is a monthly point and figure chart. You can see at the bottom here, it goes all the way back to 2000. So it illustrates the drop in the 2000 and the 2008 pullback in the market. So I want to show how the market is reacting on a monthly basis. And as you can see here, we're still in a column of X's going up. We have not turned down yet. The market would have to go all the way below like 1900 before we'd pull back, which is a healthy drop in the market, don't get me wrong. But according to this chart, that would tell us that it's still considered normal market action, that type of pullback. So until we get below that, that's when you would kind of want to pull out the fire hoses, baby, and start paying attention. Right now is not one of those times. So it's something to watch, but we still haven't gotten a full-fledged signal that it is, a dire situation. I can say that those that are clients, some of my models have that have a little bit more activity to them have already started to hedge quite a bit, actually. And so those are a little bit more active, and so we have protected some of the portfolios in doing that. But it depends on what type of portfolio you have and what type of conservative investor you are, as to see what type of hedging would take place. Now, the next chart is a weekly chart of a standard chart, I would say, of the end of the Dow Jones, which is the Dow 30 that you'll see on the TV in the evening. They'll tell you the Dow Jones is up 200, down 200, up 50, down 50. It's a more popular type of market index that quite a few people follow. I prefer to follow the S&P 500. It's a little bit broader, but quite a few people follow this, so I thought I'd put it up. But I did want to show this chart for one reason. This goes back all the way to 2011 as well. This is a weekly chart. Each bar is 1 week worth of market action. So as you can see all the way to the right where my cursor's at, this last week it's been tough on the market, very tough on the market, but we've had a couple weeks of that. But if you see the blue line I drew in here, the dotted line, we've had a pretty nice uptrend. We've touched it a couple times. We touched it back in July. We rose up, and now we're touching it again. So this is another scenario where I'm showing that the market, I think, would have to break this line, and a few other charts would give me some indication that we have more downside to come. Whether this is it, I do believe we will eventually have a pretty good pullback. If this is it, I don't know. We'll have to wait and see if the market pulls further back to give us a little bit of indication that this is the time. My final chart is a S&P 500 monthly chart. I've shown this maybe a couple times on my videos. This chart goes all the way back to 2000, and it illustrates, again, as the point and figure chart did, the two big dips in the market. And you'll see we've had a run up ever since 2009 with a couple pretty good pullbacks. The one I want to make the part I want to look at real close is right here from 2013 going up. I have made comments many times that we have not touched this blue or red line and closed below it in quite a while. It's going on 30 months, I believe, and we still haven't done that. And the market, when it's not touched that tells us it's very strong and very healthy. So that's a good sign. The negative part is that it can't keep doing this. It has to pull back. And you can see we have two boxes of red back to back. This is monthly charts, by the way. So we had a down month last month, as I showed earlier, and we have a down month so far for the month of October 1st. This chart is as of today. So whether it continues like this, I don't know. But this is another good sign of a big picture look that tells us when we start to see some breakdown and moving below these blue lines and red lines, that we want to pull out the yellow flag, possibly the red flag, and caution is warranted. Don't see that happening yet. But I believe it might happen sometime soon, so we'll have to pay attention. But as I mentioned, the market did have a rough time in September. We could see a little bit more volatility in October, and we'll have to wait and see. But the best way is to pay attention to the charts and be very active and make adjustments as the chart tells us you need to make adjustments. Don't react until after you see some visual confirmation, and rather than using emotion, it's always the best way to go. If you'd like to see more videos, we have a subscribe button right below. We'd like to see you subscribe to our video. This is being posted on my blog, and if you are not a member of our blog, you're welcome to submit your email and name, and we'll send updates to you automatically, so you don't have to worry about coming to YouTube to check it out. Hope to see you soon, and if you have any questions, don't hesitate to comment. Thank you.